The Canadian government is spending $30 billion annually on mortgage bonds and calling it zero in the deficit. But is that actual money printing? Today we find out. Welcome to the Daily Brief Canadian Macro. I'm Steve. Two creators on deck today. Russell Matthews with a deep dive into what he calls hidden government spending, the financial engineering happening just off the official books, and Market Mania on whether government relief programs are actually making inflation worse. Market Mania makes a compelling case, but there's an important caveat the data doesn't support, and we're going to walk through exactly why. Let's start with Russell Matthews. The government just reported a $67 billion deficit for 2025-2026 in the recent spring economic update. That's already a difficult number, but here's what's not in it. Russell Matthews identified that Canada's government has quietly become the largest single buyer of Canadian mortgage bonds. $30 billion annually since 2024, with $65 billion already on the books, and that none of this shows up in the official deficit because it's classified as an investment asset rather than spending. He also flags the new $25 billion Canada Strong Fund, which he, along with the Daily Brief, distinguishes from a true sovereign wealth fund on a critical point. A real sovereign wealth fund invests surpluses. This one is funded by borrowing from a government already running a deficit. The asset and the liability are created simultaneously on the government's balance sheet. The third mechanism Matthew highlights is the Defence, Security and Resilience Bank. Canada commits $10 billion, pays $2 billion up front, and then uses that as collateral to access $50 to $80 billion in further financing capacity. Leverage, essentially, that doesn't show up on the sovereign debt ledger. And then there's the bond market itself. Matthews notes that nearly 50% of Government of Canada bonds are now held by heavily leveraged hedge funds. His concern, if markets shock and those funds need to be unwound quickly, the selling pressure hits the bond market hard, with Canadian taxpayers ultimately backstopping the risk. The takeaway for investors follows directly from the risk. If the exposure is hidden inside government-backed structures, get outside them. Matthews points to TFSAs, index ETFs, and alternative assets as a starting point. Moving on over, Market Mania tackled whether government relief programs are actually solving the cost of living problem or making it worse. Their core argument is that programs like the grocery benefit and fuel tax cuts inject demand into an economy without fixing the underlying supply constraints, so prices adjust upward quickly, and the benefit evaporates just as fast. The Pemex example is instructive here. Mexico kept gas prices artificially low through state intervention, which bankrupted the state oil company despite it being government-owned. The subsidy created demand the supply couldn't sustainably meet. Their conclusion, whether it's a conservative tax or a liberal stimulus payment, the result is the same. You're pushing more dollars into a market that can't produce more goods fast enough, so prices rise. That part is correct. If you want food and gas to be more affordable, you need to produce more food and gas. Putting money in people's pockets to buy the same fixed supply doesn't make anything cheaper. It just redistributes who can afford it temporarily before prices adjust. But Market Mania makes a second claim that needs a closer look, that government borrowing to fund these programs is itself money printing and therefore inflationary on top of the demand effect. That's where the mechanism matters. There are two very different things that can happen when a government issues bonds. If those bonds are purchased by existing investors, like pension funds, insurance companies, foreign buyers, and retail savers, then money that would have otherwise circulated in the economy is redirected into government debt. The total money supply doesn't change. You might get crowding out of private investment, but you don't get new money in the system. That's not money printing. The money printing scenario is different. That's when the Bank of Canada steps in as the buyer, expanding its balance sheet, creating new reserves, financing government spending with newly created money. That's what happened during COVID. That's when M2 money supply exploded, somewhere around 16 to 18% growth. That was genuinely inflationary, and it showed up in prices. Right now, M2 growth is running at 3.7% year over year as of February 2026, modest and broadly in line with nominal economic growth. The Bank of Canada's balance sheet has been shrinking, from $316 billion at the end of 2023 to $277 billion at the end of 2024, quantitative tightening. The central bank has been removing money from the system, not adding it. So Market Mania is right that handing people money to buy the same amount of goods is inflationary, but the additional claim that the borrowing itself is money creation only holds if the Bank of Canada is the buyer of that debt. And right now it isn't. Private investors are absorbing Canadian government bonds, and the monetary transmission mechanism he's describing isn't currently firing. The question Canadian investors should be watching: if deficits keep widening and private appetite for Canadian bonds softens, particularly from those leveraged hedge funds Matthews flagged, does the Bank of Canada eventually become the buyer of last resort? If that happens, you get both effects at once: inflationary handouts and inflationary financing. But we're not there yet, and the data says so. Both creators today are pointing at the same underlying risk from different angles. Matthew sees the hidden leverage, the off-balance sheet financing mechanisms that quietly transfer risk to taxpayers. Market Mania sees the demand-side distortions, the relief programs that mask rather than solve structural problems. The through line is this: Canada's fiscal position is more complex and more exposed than the official numbers suggest. The deficit understates the true financing burden. The relief programs don't fix the supply side, and the bond market is increasingly held by players, leveraged hedge funds, who can exit fast. None of this is a crisis today. M2 is well behaved. The Bank of Canada is not monetizing debt. But the conditions Matthews and Market Mania are describing are exactly how you get from here to a crisis. The mechanism isn't broken, it just hasn't been triggered yet. For Canadian investors, the indicators to watch are simple: M2 growth rate, Bank of Canada balance sheet size, and the composition of Government of Canada bond buyers. If those three things start moving in the wrong direction at the same time, the thesis both creators are building towards starts to matter a great deal more. Well, that's your daily brief for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss our next brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.